Welcome back, traders. Now see the Fed cutting 25 basis points in September, 100 basis points by year end. Joining us now to discuss former Dallas Fed President Richard Fisher, who's a senior advisor at Jefferies and a CNBC contributor. Great to see you. So
a friend of yours, Wilfred. I haven't seen you for a while.
Indeed, great. We last saw each other in March when I was back last time, so it's good.
Correct.
We always manage to sync up, which is good news. What do you think? 25 basis points, or do you think 50?
Well, right now, I would say 25 is the most likely outcome. We'll see what the employment numbers are like before the meeting. We've yet to see that shoe drop, and the inflation numbers are proceeding. I thought Powell was circumspect in his comments, although he indicated clearly where they want to go. The question I'm talking about his comments out of Jackson Hole. Mm-hmm. And we'll just have to see.
Do you think we'll get the 100 by year end, or somewhat similar to the start of the year? Do you think the market's got a bit ahead of itself in terms of pricing in the total number of cuts?
Wilfred, I think the market is always getting ahead of itself here. There's a lot of wishful thinking here. Again, the market has been forecasting rate cuts going back to the original idea of possibly 6 cuts this year. And now you've got, of course, recession. We've been talking about it forever. It's not happening. It's happening in the manufacturing sector, no question. So we'll just have to wait and see. But I think the Fed has to be careful not to indicate any kind of sense of urgency or panic. And they have to continue on their deliberate course, which is what Powell has been very good at, particularly since they recovered from their letting the inflation horse out of the barn, as I like to say, with the transitory argument. So I think a quarter-point cut would be a good start, and then we'll just have to see what the data shows us from there.
Given that it is an election year, do you think that indirectly affects how Fed Chair Jerome Powell is thinking about future rate cuts, the size, maybe taking a more conservative approach, if at all?
No. I sat at that table for 10 years under 3 different chairmen, starting with Alan Greenspan. And Jay Powell sat to my right for my last 3 years. I got to know him very, very well. Politics just does not enter the discussion. And I know we keep saying that over and over again. I think more than any recent chairman, particularly Powell, is hell-bent on making it clear, and he's done this over and over again in his comments, that that's something that's not going to give them a direction one way or another. They'll do what's right. Look, the big issue here in terms of rates and on the yield curve, short term, clearly the Fed has the greatest influence, no question. But my biggest concern here is what's happening with the increase in government debt financing. I mean, interest cost of carry, we're running $1 billion a day. Now they're running $2 billion a day. As rates have come up, and some 22% of the outstanding debt is now in T-bills. Those are being rolled over at a rate close to 5%. That's up from 2% previously. This, to me, is the biggest concern that I have right now. It's not so much the Fed. I feel comfortable with them. Yeah. The question is, what's going to happen with the cost of carry? What's going to happen with the growing volume of Treasury auctions? Are we running a risk with China reducing their holding and the Fed, even though they're titrating it off, selling off or letting roll off the remainder of their balance sheet from that large size that they collected? Who's going to buy the stuff? At what price? And do we run the risk, as Canada did some years ago, of having a failed auction? That will determine the key interest rate, which is the 10-year and the 7s and so on. That's what we have to know.
Richard, it's David. That'll be a bad day if it happens. I mean, it hasn't yet, and then we'll have plenty to talk about. But listen, we are in an election, to Seema's point, coming up. I mean, Wharton just did a nonpartisan look at both candidates' plans. I think Trump's plan would add as much as $4 trillion. That's still including the economic growth over time, over 10 years. Yep. Harris is below that at about $1.2 trillion. Nobody, though, talking significantly about deficit reduction at this point in a meaningful way, are they?
They're not, and they're projected right now to be more than $1 trillion every year for the next 10 years at least. So I'm a central banker by trade. and I stay away from politics, but if you look at the economics of both sides here, there's no discussion on how you reduce the rate of growth of deficit expansion and how you're going to deal with the burden of the cost of carry for the U.S. government, which now exceeds that which we spend on our military at a very difficult time and challenging time globally. So I appreciate the Wharton study. They don't seem to want to talk about it, these two candidates, and they're going to have to address this if they get into office because it's a serious matter. Having said that, it's the Congress that determines the budget. Mm-hmm. And the Ways and Means Committee has also been negligent under either administration in trying to rein this in, and that's where you decide who you tax, what you tax at, and where you spend.
Richard, we have to leave it there, sadly, but great to see you. Thanks for joining us.
Well, have a great Labor Day weekend, and we'll have a happier topic next time we talk.
Yeah, we will indeed. Great to see you, former Dallas Fed President Richard Fisher.